Good afternoon, friends. We have Mr. Sunil Subramaniam, our strategic advisor, with us, who will be talking about mutual fund outlook for the 2026. 2025, have been you can't say a bad year, but have been neutral. The market has come back from 26,000 levels back to 26,000, but portfolios have not shown good returns because small caps and mid caps have not performed. Uh, so we will understand from him how the year was 2025. What are the factors that drove the returns and commodities, gold, silver, and all which went up, and the performance of all different sectors. And then we will also ask him about the outlook for 2026. So welcome, sir.
Thank you.
So, sir, just wanted to know, how would you summarize 2025, from a mutual funds investor's perspective?
I think that, so first of all, I think it was a year in which there were multiple shocks, right? If you go back to the same time last year, Mr. Trump had just come to power, but nobody knew that from January he was going to start this whole tariff war. So we're totally unexpected. So somebody sitting and saying for the new year, right, would have seen from September FI started selling. So that would have been one thing in the mind. Second was Mr. Trump has come to power, but how bad or good was his things going to be was not very clear. So that was one negative for the year that Mr. Trump took on a make America great again, make the world worse again, kind of a highly polarized view. The second fact which affected the markets, though by the end of the year it did not, was the Indo-Pak conflict. Because the Pahalgam attack and that naturally it caused a bit of tension, and so that period was a nervous period, right? That was the second aspect. And the third aspect was, I think, that the currency weakened far more than expected. I'm trying to put ourselves at the beginning of the year. So nobody anticipated a currency sharp weakening of 6 to 7%. Nobody anticipated a tariff war coming and taking over the world dynamics, and nobody expected a Indo-war conflict, Indo-Pak conflict in the middle to affect us. In fact, the view was positive because Mr. Trump and Modi had a great relationship. So the hope was that that would actually take India-US relationship forward. But the year
Correct.
turned out very, very opposite. Hence, I think that the important thing from last year's perspective, if you look at it, is that the diversified portfolios have done better than the concentrated portfolios, because those bets that you took at the beginning of the year, right, have not paid off. Like, you would have said that FIs are selling. If they continued selling, you would have expected the impact on the large caps because FIs deal in large caps. But large caps turned out to be the best performing segment. So the
Correct.
unpredictability of the markets came to the fore. And I think it reinforced that at no point should you be undiversified, that your portfolio must carry a reasonable diversification. I think that is number one point. The second, though we'll dwell on this later, I think it showed the strength of the SIP investor. I'll come to that point when we discuss that point later. But I think it also showed the strength of systematically approaching the market. I think these two are the key takeaways from the market. True diversification. And here, since you mentioned commodities, so diversification is not just about equity and debt. I think the market taught a lesson that there are asset classes
Okay, asset
cannot
classes.
ignore. So when you then now look at it, right, a customer has to look his entire portfolio. And for all somebody would put money in a bank deposit, would have had no volatility, and would have at the beginning of the year locked on to 7.5%, which is what the average mutual fund return was during the year. So
Correct.
the true value of diversification, I thought, came through because the volatility was unprecedented in terms of what the year showed us.
So, what do you think? What were the key, global and domestic factors that shaped the mutual fund performance in, 2025?
So I think that I did mention the Indo-Pak War, but like I said, the market absorbed that very well. So while it was a major event, it did not really affect the investor returns to that extent. So I would say that, so two, three things contributed here. The first is, I would say, is that what hurt this year was what happened in the previous year up to September, when the market ran up to unreasonable levels. I think the up to September last year, the market was in a roaring rally. So that I think that was something that affected because FI has realized that India had become too expensive. And that overhang of valuations was there throughout the year as an impact, especially relative valuations. Why I point out valuation is for an FII, India is a stock. So when you looked at India versus China versus Brazil versus South Korea versus Taiwan, India looked expensive. So I think the most biggest thing affecting India was the FII outflow, driven mainly by our excessive valuations over other emerging markets. Number one. Number two was the tariff playout, where while there was a leveling playing field because most countries got 20 to 25% tariff aage piche, except China, of course. India, the additional 25% proved to be a big negative shock. That, because we were buying oil from Russia, that Mr. Trump would choose to punish India to bring Russia to the talking table, right? Was an unexpected, and that is still not gone away. So that's a second major impact on a negative perspective. The third impact was, of course, the currency, because currency then made everything more difficult. Because for FIIs, they lose money when currency weakens, because they're putting from a stronger currency to a weaker currency. So the third major global volatility impact was the currency impact. The positives were also there because, as you saw at the end of the year, we have had decent positive returns. So positives were, I think, a very proactive government flip in stance from just capex to capex plus consumption, because they started with the income tax rate cut. There was a change of the RBI governor from Mr. Shaktikanta Das to somebody who would come from the finance ministry. So there was a lot of talmail, if I may use an English word, between them, which helped to proactively do rate cuts, liquidity infusion, CRR cuts, and the like. And then the government followed with another strong fiscal measure, which was the GST cuts. So I think that a strong, positive monetary plus fiscal policy response was, I think, a great cushion to the volatility that we faced. And I think that is also an important factor that affected returns during the year.
So, do you believe that 2025 was more of a valuation reset for Indian markets, or you think it's a start of a longer consolidation phase in equities?
I think it's the start of a longer consolidation phase in equities, because FIS sold roughly 1.5 to 1.6 lakh crore. DIS bought 7.5 lakh crore.
Right.
Oh, that's 5 times the amount that they sold. But still, right, you found that the DII's buying meant the valuation never came reasonable from an FIS perspective. So this constant DII buying, why it supports from a volatility perspective, it supports that sharp corrections are not there to scare the investor away. It also means that valuation never become reasonable from an FII perspective. Even today, after a year of fairly not so great performance, the market has still not reached the 5 year. We are still overvalued even on a historic 5 year.
Five
So
year average.
that valuation reset has not happened yet. So what it then indicates is a period of consolidation in terms of the returns from the market, because FIIs will be hesitant to come in strong numbers unless there is a big trigger to which makes things favorable to India. So I think you should, as an investor, be prepared for a decent consolidation rather than there being any valuation reset which will lead to a new uptick. No.
Right. So that is why I think, because domestic investors invested 7.5 lakh crores. That is why if you see large caps performed, I think that money went into the large caps, but mid and small caps didn't perform because the money didn't go in that sector.
Which is where I think the reason for the consolidation I expect is again that DIS had a choice of buying large, mid, or small, but they chose to buy large. So you see, I think that clearly tells you that even domestic fund managers felt that mid and small caps were overvalued. So I
Yeah.
think the fund managers, they say, they walk the talk. So it means that their actions speak louder than words.
Right. Right. So you see, like we're talking about small cap, after the sharp correction now in mid cap and small caps, how you should investors approach these in 2026? Do you think large cap will continue to perform, or clients should start focusing on mid cap and small caps to start nibbling?
So I think so I would put it this way, it depends on the risk appetite of the investor. So I would not like to give a one solution. I'll tell you why I say this. Is that if you now sit down and look for the new year, we don't know what new negative surprises are going to come. We have no idea about that. But we know that what positives can happen. The positives that can happen is that a trade deal can be signed over the year. The timing of it is what is uncertain. Whether it'll happen before March, or maybe June, or maybe second half, we don't know. But I don't think that we can go another 365 days without a deal being signed, because all the noise about the deal is positive. It's just not getting signed. So if I say that it's going to happen sooner rather than later, right? The on the back of that trade deal, right? If there are enough positives from India from the trade deal. So the second aspect is, how will the trade deal actually find out? Will it be perceived as pro-India, or has India given up too much to America? So that's the second aspect. One is the deal has to be signed. Second is the deal itself has to be perceived to be good for the future growth of our GDP, right? That's the second part. When that happens, FIs will come back, right? Now, contrary to what people think, that when FIs come back, I actually expect small caps to outperform. I wonder why. Because DIs have been buying those large caps that FIs have been selling this year. So when next year, whenever FIs come back, I expect DIs to sell their large caps to them, and
And
and then shift that to mid and small cap. The reason they didn't do that this year was the valuation. But since there has been a reasonable correction in the small cap segment, they are now more closer to value. They're not still undervalued. They're closer to value. But if you look at the fact that the other thing, like I said, the other positive that I expect is the full year impact of the GST and the rate cuts. Because the rate cuts occurred through the year, the GST cuts occurred in the last quarter of the year, right? You will now next year see a prolonged impact. Like, for example, consumer durables like refrigerators and air conditioners did not see an uptake because they are sold in the summer. So the
yes,
impact of the GST will be felt in consumer durables in the summer. Similarly, real estate hasn't participated in this whole GST cut, rate cut story at all, because there's been a supply issue. Because there are not enough affordable housing projects launched by developers, which next year will get set right. So I actually expect that also a positive. When that happens, it will be the mid and small caps which benefit from that. Because these consumer durables, realty, these are all not large cap names. And some FMCG names in consumer are in large cap, but by and large, these are mid and small cap. So if this full year GST impact pans out, then the growth in the mid and small caps should be better than last year's growth, closer to their valuation, and that would tempt domestic fund managers to take money off the large cap table when FIs come back. Obviously, there'll be a time lag. They'll wait for them to come, make the prices go up a bit, book the profits, and then shift. So by the end of the year, I think small and mid caps will start outperforming. So why I'm saying is, so your risk appetite is important, because I expect the FIs to come back. Large caps are never going to underperform. There will be some profit booking by DIs and diversion to small and mid cap, but they're not going to underperform. So if you're a risk averse or closer to moderate risk person, you would still maintain a large cap, flexi cap orientation to your portfolio. But if you have a slightly long risk appetite, then 2026 is actually the year of investment, because this will now, when the tariff deal gets signed and this consumption story goes up, private capex will follow because the capacity utilization will go up. So that is a 3 to 5 year story. So I would say, from a mid and small cap, the person who's got a reasonably aggressive risk appetite should start allocating greater to mid and small. But look at this year as a year of investing in them. Do not expect that the return by end of 2026 will justify that decision. But because you're now getting them at reasonable prices, you will get a good gain in 3 to 5 years from that portfolio. So I would say, take your risk appetite into account and accordingly do the allocation.
you think like equities have, past given us 13 to 14% return. You think investors should expect now lower returns but more sustainable equity returns going forward? I
I
mean, do you
think
think this 14% will become 12, 11?
So I think that to my if you have been in a 13 to 14% expectation band, you will not be disappointed from a broader market. I think that only thing is, it may not happen in 2026. So I think if you take 2026 to 2028, 2029, you take that as a 3 year period. I think from a broader market to expect a 14% return is not at all a problem. You will easily get that to happen. And in fact, large caps itself should deliver 11 to 12%. But mid and small caps should deliver more, provided you wait out the 3 year period. So on an average, your portfolio delivering 14% is. Now the problem is, Rajneesh, is that many people who have come in, let's say post COVID, are expecting 20 to 25% returns. So
Right.
I think for those people, you have to moderate it to 14. I think 14 is reasonable, right?
If you have a well diversified portfolio in flexi cap, mid and small, so then I think 14% is
14 is
possible.
yes.
And sir, how important do you think will be, stock selection and fund manager discipline, be compared to broad market trends in 2026?
I think that the broad market trends will do better than stock selection in the coming year. And I'll tell you the reason for that is because the whole, see, out of the 500 Nifty 500 stocks, 370 are well below their lifetime highs, right? So, and fund managers in their portfolio, right? Because you have a 50 lakh crore MF industry already in equities. They've already deployed into that which they think will do well. Now, incrementally, right, they just have to back that earlier conviction based on the earnings season outlook. Now, a fresh stock picking is not really needed because they've already done the stock picking. But the rally, when it happens in the manner that I expressed, will be a broader rally in the small and mid cap space. So, as long as you're present in the smaller and mid cap space, that's good enough. I don't think stock selection this year, in the last year, it was important because it was a very volatile year. And next year, I don't expect the volatility to be as high unless some big world event happens. I think the volatility events have happened. So now it's a stabilizing year. So I don't think stock selection is that important, but fund manager selection is important by the investors
Right.
because a lot of the portfolios are already sunk in. Okay, so fund managers can't change the entire portfolio overnight. So the difference between, for example, in the multi-cap category, which has large, mid, and small, the best performing multi-cap fund this year gave about 6.5%. The worst performing gave minus 8.5%.
Yeah, I saw that there was a lot of, spread of
A
10,
lot of
12%.
so I think choosing the right fund manager for which the value of an advisor is important because you have to study portfolios in detail, understand thought process of the fund manager, and then only invest. Because lots of fund managers who made these calls a year ago, they how far are they willing to change and adapt to the new norm, right? So you have to assess that. So I think the value of an advisor comes through because I would say rather than a broad small cap mid cap allocation, you should also focus on the kind of fund manager who has protected the downside and managed to capture the upside by truly diversifying. So I think that's important. Fund manager selection is more important in this period.
And so now with interest rates, coming down, stabilizing or still, room to I think little bit come down, and inflation is also stable now. It's moderated. So how attractive do you think debt funds going forward will be in 2026?
So first thing is that I think that the most recent data is showing that deposit growth is slowing down and credit growth is outpacing deposit growth.
Right.
So in the market, it's very hard for interest rates to come down because when credit is greater than deposits, no banks will be forced because they can't pass on the rate cut in deposits any longer, and they will be forced to keep the lending rates reasonably high. So I think from a real world period, it's contained. Second is the whole effect of the GST cut, the tax cut, as well as the RBI's policies are to reinflate the economy. So I don't think this hyper low inflation that we have been recently experiencing is sustainable. So I think even RBI's own policy projections for next financial year or the first quarter are 4.1%.
4%. Yeah.
From 2%. So I don't think that we are going to see a very low inflation year because we also had two very good monsoons back to back. The third year, it's very probability of having a excellent monsoon is also that much lesser. So I think we are in for a period of reasonably high inflation, right? And I would say credit growth picking up because the entire consumer durables and real estate story is financed by housing finance companies and by NBFCs. So credit growth will be strong, and when private capex picks up, it will also be strong. So the classic way that debt mutual funds have delivered returns is in a dropping interest rate scenario, which there is some room for RBI to cut because the real rates are still high.
Right.
Okay, so even if inflation goes to 4, our rates are still having a real. So there is one or two rate cuts more from RBI is possible. So, but that whether that will be translating into the GSEC side in a strong way, we have to wait and see. So from a debt mutual fund, I actually believe that because of the credit growth picking up, it's a good time for credit risk funds which will deliver you a good accrual yield, which can beat bank deposits, right?
Yeah.
Rather than betting on a duration kind of a dropping inflation, dropping interest rate story, I feel that that may not play out. I think it's already played out because the big move there, I think, has happened. So I feel that debt mutual funds, you can look for those which are taking slightly below double A minus, taking that because lending rates are definitely going to move up with both personal consumption as well as corporate capex picking up. I would say interest rates at the market level will be good. So you credit opportunity funds probably represent a decent outlook for the year.
So this thing, what you're saying, the if the deposit rates are low,
Mhm.
okay, and the interest rates are coming down, so then if banks have to increase the deposit rates, so then I think they will have to take a hit on margins. You think so?
So banks will not increase deposit rates. They will go for
So how will
alternate
they get the
sources,
deposits then?
alternative sources of raising money, overseas foreign currency
Okay.
borrowings, like long-term debt capital market. They will go and tap the market. See, the other thing is that the for the deposits also, I hear a move that the banking minister, banking heads or banking uh, whatever segment has approached the finance ministry to make bank interest tax free. Okay.
So
They have made a plea that savings bank interest and FD interest should be made tax free. Now, I don't know the finance minister has the room to accept that because that
I
would
think
be.
for senior citizens at least they should make.
No, why I'm saying is if that happens, that will be a big relief for banks because
Right.
then, from a competing perspective, they'll be able to raise deposits. Number one.
Right.
So, I'm just saying the second is that, see, credit deposit ratio has already gone to 80%. 70 is the ideal. So clearly credit demand is there. So actually they may raise deposit rates is what I feel. Though the margins will not get affected because lending rates will keep pace with the rise in deposit rates. Because when credit demand is there, demand exceeds supply, right? Banks margins will be more or less maintained.
Right. So you think in a volatile and uncertain environment, like this, you think a multi-assets and hybrid funds have become more relevant now?
I would say that I see if you look at it again, I would point it out to the risk appetite of the investor, right? What multi-asset and hybrid funds do is to protect the downside very well. And in the recent past, multi-asset funds have delivered 20% returns also because of the gold and silver component delivery, right? So it's a sweet spot because that's normally not the way a hybrid category should perform, right? So I would say that multi-asset funds should now be a core part of the portfolio because from a taxation perspective, it's better to buy gold and silver through a multi-asset fund than directly through an ETF, right? It's important to have commodities in your asset allocation, and multi-asset funds represent the best way. And I think the last year returns of between 18 to 20% make the case for those funds. So I'd say multi-asset, but I'm not so sure about the dynamic asset allocation or the hybrid funds because the point is that if you're allocating to multi-asset, it already gives you the benefit of the dynamic asset allocation, right, in that fund. So why do you double it up, right? So your multi-asset allocation should be your substitute for your balance advantage fund. And your other aspect, I would say, is to put a multi-cap fund. The reason I'm saying is that I expect during the course of the year, the initially large caps will continue to outperform. Then the trade deal and the FII buying comes up, mid and small caps will start. So a fund manager will have that 25% cushion to put it in large cap today in a multi cap fund and gradually shift it to mid and small cap as these events play out. So I think a multi cap fund is a good way to play, or if you're a little conservative, a large and mid cap as a category. So I would say that don't go purely for large cap or flexi cap. Go into the large and mid cap, multi cap space where you give the fund manager the flexibility to catch on to the mid and small cap as and when the opportunities present themselves. So a good combination would be for me multi cap and multi asset allocation. And the mix of the two depends on the risk appetite of the customer. Today, multi asset allocation, even an aggressive customer should have because he has to play gold and silver through that. So it's not.
Yeah, because over the years now we have seen, the ratio of hybrids had, fallen last
Yeah.
after COVID. And
Yes,
now suddenly because of gold and silver, allocations to multi-assets have started increasing. So I
correct.
feel over a longer period of time also gold has given a decent return. So I think that should be a part of the portfolios.
And the case for silver is
But
growing
yes,
stronger by the day,
yeah, silver is also
because China has now put
depends
a
on the
export
profile.
export curb from January 1st on silver from their country. And industrial demand accounts for 60% of silver demand even now. So I think that silver story will also continue in the new year. So I think that a multi-asset allocation should be a core fund in most people's portfolio.
Next, sir, we have seen 2025 or the year, where SIPs, month on month, we saw that SIP inflows were stronger. And despite the market volatility, there was not a much fall. So what does this say, about the investor maturity? You think Indian investor has become matured?
I would say more than investor becoming mature, I think the distributor has become mature and he has advised the investors well. Because if you see the stoppage of the SIP in the direct, when do it yourself is far higher than with this. So I would say the value of an advisor and a distributor in pointing out to the investor, I think three things. One is that the concept of rupee cost averaging with a when because they have tied the SIP to a goal. So when you do that, then you're actually able to convincingly say that any correction in the short term is actually beneficial for you in the long term because of rupee cost averaging. I think that's the first lesson, right? That's one thing. The second aspect is even today, 3-year returns across fund categories is between 20 to 25% on SIPs. If you have a 3-year SIP, so I think that customers who have got a longer term, the distributors are able to show them the 3-year returns and say, look, 3-year returns are like this. So easily, this just was a particular year that was bad. So that's the second aspect. And the third aspect is, I think, of course, the fact of the AMFI's mutual fund SAI campaign, which has made SIP appear to be a completely different product from mutual fund. People say, do you invest in mutual fund? No. Do you put SIP? Yes. So
Yes.
conceptually, I think SIP has caught hold of the public imagination, and SEBI's efforts to incentivize women investors, the small, incentivize the small cities where they're giving an additional thing, and introducing this pocket SIP of 100 to 250 rupee SIP. All of these have contributed to the growth of SIP. So I would say that it's too early to say it's a maturity which is making them, is because it's in a growth phase. The whole SIP is in a growth phase. So it's too early for to say that it's mature, but it's because it's still not disappointed on a 3-year basis. It's helping people stay the course. So I think that's the real thing behind SIP, and it's helped because more than 3 lakh crore of the 7.5 lakh crore buying that domestic mutual funds have done, 3 lakh crore has come just because of SIPs.
How critical is behavioral discipline in achieving long-term mutual fund returns?
I think this year has proved that it's absolutely critical, because I think that if you keep switching funds, right, in the beginning of the year, you would have felt that FIs are selling, so large caps will underperform. You would have allocated more to mid and small cap, and you would have got the worst of the bargain on both sides. So this
Right.
trigger happiness, which comes from just chasing the returns, looking at the fin influencers, the news flow, that ye ho raha hai, or they would have panicked when the Indo-Pak war came. Somebody would have panicked and sold. So I think this year has taught the value of discipline, because those who stayed the course, right? I would say that, and I was seeing this. You were saying about SIP, for example, large cap funds have delivered somewhere between 8 to 9%. Okay, the
Right.
median peer average.
This year, yeah.
Large cap SIPs have delivered 10 to 12%. Why? Because the year ended well for large caps. Whereas mid cap, small cap SIPs have delivered negative only, because it was a falling knife. So when the end result is lower than the beginning, the rupee cost averaging doesn't work, right? So what I'm trying to say is, but that if somebody had run a diversified portfolio, you would have had the benefit of volatility in the large caps, may have been hurt in the SIP in the small caps, but in the long run, the SIP in the small cap will give far better return because the correction has been far higher. So I think that discipline clearly will have its rewards. And I think that investors should first of all identify a goal and stick to their investment in a disciplined manner till the goal is achieved. I think that's the primary lesson this year has taught.
So, what are the biggest risks investors should be mindful of in 2026 now?
So I think that one is that the uh, Festival season auto sales have been very good, but have the companies, for example, sacrificed margins to achieve those sales? The earning season. So one of the big risks is that the earning season, right? A lot of foreign brokerage houses are expecting a 13 to 14% earnings growth. But the risk is that if it doesn't come through, because corporates have been facing that pressure. So that's number one risk. Number two risk is that while we talk that we are the fastest growing country and now we are showing 8%, 8.2, the fact is that the low inflation means that nominal GDP has been declining. A
Right.
year ago, it was at 12% and then declined to 10. The budget projections were for around 10, but now they are at 8.5. So this inflation, while it's good from a rate cut RBI perspective, low inflation, it's not good from a corporate EPS growth perspective. So the economy and the government's tax revenues go with nominal GDP. So this hurts the fiscal business. So one of the risks that we have is this low inflation continues prolonged manner. So that's a risk to the stock market. It may not be a risk to you as a consumer, but for the stock market especially, it's a risk. So we should hope for a decent pickup in inflation to a 4% levels. It's fine. Nothing 4 to 5% inflation. So that is the second risk. The third risk is that India has been taking a tough stance on the trade deal on agri and dairy, the red lines. Now, for America, India is not important because America's total deficit of trade is $1.2 trillion. Our trade surplus with America is sub of $50 billion. So we are not even 3 to 4% of their total deficit. So we are not very important to them. So this tough stance by India, so America is not under any pressure to yield to that. So if they say, let's stretch out India a bit more, let them sweat a bit so that they come to the negotiating term, and you pass through more than half of the year without the trade deal going through, then FIs are unlikely to return in a big way till that happens. So I would say the trade deal still remains the biggest event risk for us. And till that is solved, it remains a risk. Because if for so long it's been like, oh, agle hafte ho jayega, agle mahine ho jayega. If various people have been putting various dates to it. Like the chief economic advisor said, November 30th will be done. Somebody else said some other date. So fact of the matter is, nahi hua hai. So till that happens, that remains an overhang risk on the Indian economy. And then I would say that the GST cut by the government, we have to see the budget numbers, how the fiscal situation is panning out. Because government would have lost revenue because of the GST cut. But I don't think the volumes are yet picked up throughout the economy in the consumption space except for automobiles. So this year's balance sheet of the government, and you have a rupee which has been weakening, right? So from a fiscal perspective, the budget. So as a result of which, how do they project for next year? And how much will the government spend on capex? How much will they try to give to the middle class as additional money to spend? I think it's a risk because foreigners, again, if India chooses to go and say that we will spend more on consumption, it may be good for growth, but it may not be good for our rating. So I'm saying, so from an FIS, because the FIS are a key part, right, to that. On one more risk is that, see, what I'd like to point out is we are blaming the FIIs for our market's performance for last year. Any newspaper you open, any TV channel you open, it is that, that foreign hand. कि FIs ने बेचा Indian market. But if you really look at it, I'll point out one fact. FIs sold 1.5 lakh crore. DIS bought 7.5 lakh crore. Who sold the other 6 lakh crore for DIS to buy? It was domestic promoters, venture
Motors.
capitalists, right? And other people. So what I'm trying to
Right.
say is it's not as the FIS was only 20% of the buying by the DIS. Balance domestic niveshak ne becha hai. So what I'm saying is that corporates, owners who have sold their stake saying this valuation is too high, they are giving the wrong message. So the risk is that the corporate should not continue to do that, right? Because if they stop selling, the market will go up because of DIY buying. Because this year, 7.5 lakh crore. Next year, if you are now running at 30,000 crore SIP book, for the full year, you should get 4 lakh crore only from SIPs. So there is that plus, even if you put a number of 10,000 crores a month in lump sum sales, 1.2 lakh, you're talking about 5.2 lakh compared to 7.5, you're still going to get 5.2 lakh of DIY buying. But if promoters and all these people are going to go and part with their money, their stocks, then that will make sure the market doesn't go up because that selling and buying will set off. So I think one of the risks is that Indian corporate owners should feel that Indian economy is a growth path. I should stay invested in my business and not try to book profits from my own business. It's a signal wise. So I think that
Yeah.
trend also we should see the open offers for sale OFS should come down. Fresh IPOs are good because they expand the depth of the market and all of that. So I would say these are the kind of risks to kind of watch out for.
So next question on this, to talk about promoter. You think 2020-25, we saw I think, the biggest promoter selling, in 2025. You think that impacted, investment returns for investors
Absolutely.
by selling?
Absolutely. Because if that had not been there, then this DIS would have used that 7.5 lakh crore to buy at least some small caps and mid caps because they can't do anything with the cash in there. They have to buy something. They bought large caps. They chose not to buy mid and small caps so much. So if, because the promoters were selling, they also allocated money to those OFSs. So if that had not been there, this 7.5 lakh crore would have gone to the broader market. So I think that has been a bigger contributor than the FIS selling. And mind you, in this point, I'll point out one more thing about FIS. Despite our high valuations and everything, this 1.5 lakh crore, this that's about $18 billion, right? They have invested 40% of that amount, 7 billion in IPOs in India. So FIS actually have brought in 7 billion into Indian IPOs, primary market mein. So what
Right.
I'm trying to say is, so for them, as long as the growth justifies the valuation and the price, they will come. So I think that it's unfair to just blame only the FIIs for our
Yeah.
market situation.
Do you think this promoter selling will continue in 2026 also?
Well, if I think it will not, and the reason I say this is that I think that with the private capex picking up, right, they have raised enough money. So those see there are people who have taken money out into their personal balance sheet. There are people who have taken the money to replace debt. There are people who have given exits to VCs who supported them. Right. So if you now look at it, right, I believe that by the third quarter of 2026, the private capex cycle will start strongly. So that time they will need money to put the equity component. So now you will see that those who are expanding, those who reduce their debt, they have room to now take more debt.
Right.
Those who put the money into their thing, they can put that back in as the equity component. There may be some people who have not done that, but who need money for reinvesting in their business as capex. They will come up with follow-on public offering or rights issues to reinvest in the business. Those are excellent IPOs because they are showing confidence in their business. So the nature of these fundraising is also important, right? So I would say that the bulk of the people who thought the markets were very overvalued and pulled out the money have done. Maybe a quarter of them may be left for the new year, but bulk of that kind of feeling that the share price is too high and hence I let me take off money. I think by and large it's got
Yeah,
done.
now valuations have corrected, so I think they'll wait for another 2-3 years for market prices to move up more. And so, do you think in 2026, how should long-term investors reposition their portfolios? Their focus should be more on the portfolio quality, asset allocation, or they should be chasing themes, or momentum.
So I will say first is that one of the things which I wanted to say when you asked me about the year, I think what the year has helped to bring to individual investors is the value of risk. That reward has to be managed with risk, right? Because clearly the small cap underperformance showed you the pain of risk, right? And the large caps decent performance has showed you that reward per unit of risk because you didn't take much risk with the large cap, but you still got a inflation beating return, right? So I think that investors should now bring that risk reward equation into their methodology. So far, Indian investors have just been chasing returns and have been ignoring risk, I would say, by and large. So, of course, the value of an advisor is important here in showing them. So, they should choose portfolio where overall portfolio they balance out the risk part. So, even a very aggressive investor should choose enough diverse pockets so that it's not from so much of a downside protection that to be present in every pocket where there could be an opportunity, right? So building a truly diversified, for example, a typical aggressive investor 2 years ago would have ignored gold and silver. अरे वो तो डेड एसेट क्लास है यार, मैं स्मॉल कैप में डालूंगा. But now you would have realized that you have to respect every asset class, and in a particular time it comes and delivers.
Right.
Right? So I would say that when the investors do that, they have to now today factor in, yes, you need the reward, but what is the reward per unit of risk, which is Sharp ratio or a trainer ratio. They show it out very, very clearly, right? And so I would say that that's what this year has taught. And I would say, from an investor's perspective, make sure that you are handling the risk appetite of yours with the portfolio's risk appetite. So, there, that being said, then there's a what are the components that you should have? I would call debt as one component, right? And within debt, I said about duration versus accrual. Then you have hybrids. In hybrids, you have the typical equity debt combo, which comes from a balance advantage or equity savings. But you have the commodity angle to hybrids from multi asset allocation. And then you come to the pure equity, you have the large cap, flexi cap, which are large cap oriented, and then you have the small cap and mid cap. So I would say every investor should have every one of these in their portfolio. The proportion of it varies according to your risk appetite.
Yeah. So well-diversified portfolio will do better in 2026,
Yes.
multi-asset to multi-cap,
Yes.
depending on the risk profile.
Correct.
Okay. So what is the single most important mistake that investors should avoid in 2026?
So I think that I would say that it's to take sectoral bets. The reason I say that, if you look at the sectoral performance for 2025, what you'll see, the worst performing sectors were real estate, media, IT. The best performing sectors were PSU banks, right? Metals, and
NBFCs,
auto, right?
auto.
If you take. Now, as a person who's a typical person will say, oh, I bet in those sectors which have done very well, right?
Yeah,
So
that's a psychology.
so the point is like this, right? So even if you take away the asset classes I talked about, within equity, if you're a person of an aggressive risk appetite, you should again see IT has corrected so much, reality has corrected. Now, because it has corrected, it gives you a margin of safety. But it doesn't mean that automatically it's going to be the best performing sector for the next year. So an extreme
Right.
contra call is also not. At the same time, what has already done well, you'll be tempted to put money because its 1 year's outperformance makes even 3 years look good. But it's not that it's done well. Take auto. It was biggest underperformer at the beginning of last year. It's only the GST cut which came and changed its entire profile. So, but a 3 year return on auto is looking good today. So I would say that avoid taking sectoral bets, right? The biggest mistake you'll do is because ultimately it'll pay off. But if you want it to pay off within 2026, it's a huge risk you're taking, right? I'm
Right.
sure, for example, IT, I'm a bull on IT. I'm sure that it'll do well when the FIs come. But the key question is when the FIs come. So, so the point is that you should be prepared to play the waiting game for that day when the FIs return, when IT will catch up. But if you're looking at 2026, it may happen during the year, may not, right? So I would say that uh, don't take extreme sectoral bets for the coming year. Number one. Number two is, I would say, is that uh, do not ignore any sector or asset class. So ignoring any one sector, some people feel, oh, gold has already rallied too much, it's going to correct. There are news that silver is going to correct big time. So if you're going to go by those kind of a calls, that is the biggest risk you'll take. Rather, you say, I don't want to second guess the market, right? I let me put so I'm saying trying to predict the market in terms of sectoral asset classes is the biggest risk investors should avoid. Stay present in everything. So undiversification is the biggest risk, if I may
Yes.
say.
Right. But sir, we saw a lot of new investors coming into the market. So what should they keep in mind? When they come in 2026, let's say we want to start investing in Jan. So what should they be keeping in mind?
So I think the best way to look at is that the market and the money are your employee. They are there to do a job for you. Okay. So they will do the job that you ask them to do. So don't make unreasonable demands of the market to make of the employee. Second is to manage the employee, you need a manager, right? Because your main job is not to study the market. Your main job is not to do that. So if your money
Not
doesn't work for you, you have to have a manager managing the money, which is the role of a distributor stroke advisor. So for
come to the advisors like us.
so absolutely. So what I would say is that to the new investor is that this temptation to do it yourself, the temptation to take tips from people, the temptation to take a fin influencer and go and execute, right, is very, very high. But in the long run, right, money is your slave. Don't let the slave become your master, right? So
Yeah.
you have to manage it properly, and that's where the employee also needs a goal. He should know how is he going to be measured by. So do not make any money decision without having the goal at the end of which that money should deliver to you.
Yes, so finally, last question. If you have to summarize, 2026 in one line for mutual fund investors, like one clear action point, entering 2026, what would that be?
So I would say 2026 is the year when you invest will make the most money for you 5 years from now.
That was good. Okay, sir. Thank you very much.
Thank you.
For your insights. Nice talking to you every time. Our investors have really benefited from your, insights, and I hope 2026, will be a good year for our investors. For you and for us.
Yes.
Thank you,
Happy
sir.
New Year.
Greetings for you. Yeah, Merry Christmas and Happy New Year to you.
Thank you.
Thank you, sir.